We're very excited to have again returning guest Andrew Opdyke from First Trust Portfolios, and that you're going to have the opportunity to hear from him. He is an economist and a member of the First Trust economics team that Bloomberg has ranked as one of the top forecasters of the U.S. economy over the past several years. At First Trust, Andrew is responsible for analyzing economic indicators, writing economic commentaries, and producing articles on the First Trust economics blog. Out of a panel of over 100 economists, investment strategists, and housing market analysts, the First Trust economics team was awarded the Crystal Ball Award by Zillow in partnership with Pulsonomics in 2012, 13, 14, and again, most recently in 2015 for their home price predictions. First Trust has been instrumental in guiding the Stanger family office rebalance process since 2008. I'll cover some of the things they've helped us with a little bit later, but Andrew's team delivered critical data and content to our group during the global financial crisis and again in 2020 during the coronavirus crash. The First Trust team has consistently encouraged advisors and investors to maintain a long-term investment plan and buy equities during times of volatility. He received his MBA from Northwestern University's Kellogg Graduate School of Management and a bachelor's in business and economics from Hope College. He holds his CFA Chartered Financial Analyst designation and is a member of the CFA Institute and the CFA Society of Chicago. Folks, please join me in welcoming Andrew Opdyke.
Good morning. You excited to talk economics? You know what was missed, though, in that introduction? I was born here in Naperville at Edward Hospital. I was raised out here. My dad was a professor at North Central College. My wife graduated from Naperville Central. This is the shortest commute I have all year long. I spent the early part of this week, I was out in Louisiana. I was in New Orleans, in the Baton Rouge area. But I've been looking forward to this event for a while. You have one of the greatest financial teams in the country. And you have a great agenda today. Funny enough, you've got Dr. Ed Jardini this afternoon. He is one of the people that I like to follow the research. Me and him were messaging last week. He says, Andrew, I'm going to be in the area next week. Can you meet Friday at 10:30? And I'm like, oh, shoot, I'm not going to be in the office. I've got to be speaking at an event. And he's like, okay, no problem. Little did I know he's here for the same event. So he's at my office right now talking to our research team, and then you get to hear from him later today. He will be absolutely fantastic. What I'd like to do is lay economic framework. Okay. He's going to talk more on the market side, but I don't know if you heard about this. We had an election this week. I just found out too. There's going to be ramifications. The three things I want to hit on today is one, some of the ramifications from that election. What are some things to be watching out for as we move into 2025? Because there are likely to be some tax changes. There's likely to be some regulatory changes. There's been discussions on things like tariffs. We're going to talk about that. What does that mean both from a market standpoint, an economic standpoint, and an inflation standpoint? The second thing I want to talk about is the Federal Reserve. They met yesterday. They announced yesterday they cut interest rates by another 0.25%, but they're going to have to react to what is potentially coming down the line on the political front. And where inflation moves and where interest rates move is going to have impacts on things like the housing market. It has impacts on consumer borrowing, company borrowing. So we're going to spend the second portion talking about that second actor that's going to be on the stage next year, the side with the Fed. But then the last thing I want to do is take a step back. Right? Because here's the thing. When we had the election results coming in on Tuesday, as we woke up on Wednesday morning, there was one thing that was nearly certain. Even if you didn't know who was going to win the election, win the Senate, win the House, you could have guessed on Monday, you could have guessed a week ago, 2 weeks ago, that when the results came in, roughly half the country was going to be happy, roughly half the country was going to be upset, and then everybody was going to go back to work. Right? And Apple was going to build another iPhone regardless of who's in the White House. Amazon's going to put another distribution facility closer to our homes. NVIDIA's going to come out with another chip. And the last thing I want to focus on when we sit here today is for all the talk on the politics, all the talk on the Fed, I would argue that the iPhones, the internet, the innovation that's happened over the last 20, 30, 40, 50, 100 years has been far more impactful on both economic growth and market growth than what's happening in Washington. And I want to take a step back to look at what's happening there. So that's the plan. 3 major things that I want to hit on. And I love talking about economics. So I'm going to set myself a timer. Otherwise, I'll talk for 2 hours. Let's start talking first off with the election results. Now, here's the thing. The election results are in. We know the presidency. We know the Senate. We don't yet know the House. Okay. House votes are still coming in. There's more House seats that were up. There's smaller districts. The tallying takes a little bit longer. But what we know is we're going to be in one of 2 camps. Either we're going to see the Republican sweep, or we're going to have Republican presidency, Republican Senate, and a Democratic House. What does that mean from a policy standpoint? Well, here is what I would be watching for as we move into 2025. One of the first things that's going to get discussed is the extension of the Trump-era tax cuts, right? Those were set to expire at the end of next year, and there was debates. Depending on what the makeup looked like in Washington, those could have been completely eliminated. They could be completely extended. There's questions on whether or not they can make them permanent. In order to do that, they have to offset that with spending cuts. But with a Republican sweep, not only are we likely to see that full extension, but you're going to see a couple additional changes. One of those is there's potentially more movement on the corporate tax front. If you remember the 2017 jobs cuts, or the Tax Cuts and Jobs Act, during that time period, the corporate tax rate in the United States moved down from 35 to 21. And what they were looking at was looking at the broad landscape of developed market countries across the planet and said at 35%, the US had one of the highest corporate tax rates. And if you are an international hub, as we are, as Europe is, they said companies are trying to figure out where are we going to put our businesses. And unsurprisingly, companies were making decisions based on availability of a few things. Can we get energy? Can we get cheap and abundant energy? Can we find labor? And what are the taxes that we're going to pay for a time period in there? We saw heavy focus in areas like Ireland, heavy focus in areas of Europe because the tax rates were lower. So they said, look, we're going to bring it down to 21. That's going to make the U.S. more competitive. We went from being on the higher end of tax rates among the 10 largest developed nations to about 6 or 7. Now the discussion is that we're going to move to somewhere in the region of 15 to 18%. From a markets perspective, if you go back and look at 2018, what's the impact of the tax cuts? Well, the initial impact from the tax cuts was twofold. One, we saw an acceleration in investment by businesses. All of a sudden they realized, hey, if we're keeping more of every dollar that we produce, those projects that we were considering are now all else equal more attractive. At the same time, we've got the Federal Reserve now lowering interest rates. We have what is a pretty strong environment, a pretty strong tailwind factor for business investment. The second thing we saw was a pickup in earnings. In 2018, earnings rose by about 20%. Now, if you remember 2018, do you remember what the markets did in 2018? Earnings rose about 22% and the markets fell. Why did the markets fall? Because emotions were running high. We got to the end of that year, and at that point in time, the Federal Reserve was starting to raise interest rates after holding them near zero. Now we're moving in the opposite direction. Back then, there was discussions about a government shutdown, and if you turned on CNN, if you turned on CNBC, they had a little ticker in the bottom corner of the screen. And they said, every day the government shut down, it subtracts X amount from GDP. And they ran it day after day after day after day until the data came out and they were completely wrong, right? And we all remember that day because that's when they ran the apology special. No, they didn't run an apology special. What did they do? They moved on to whatever the next catastrophe was going to be. But our fears and our emotions ran up. Now, if you remember that, those tax cuts and the earnings growth from that had an enormous effect in 2019 when that fear subsided and we got back to fundamentals. Tax cuts are going to be the predominant piece of policy being implemented next year. Now, beyond what's happening in terms of the lower corporate tax rate, there's a second piece that you're also likely to see. This one is going to have to be more nuanced. Both the Democrats and the Republicans said, we're going to do some movement on tips. And this was targeted towards Nevada. Both sides were fighting for the votes in Nevada. They knew that that Las Vegas area was a critical piece. And so they said, look, this is really targeted towards casino workers. We're going to not tax tips. Now, what you'll probably see is movement on that space. You'll probably see it for some of the lower earning, okay, people that are maybe working at restaurants, at bars, but they're going to be very intentional about this. because there's not a lot that stops companies from saying, oh yeah, you know what? We're actually going to recategorize your income as tips in order to get past tax. So they're going to have to be very nuanced in this. They're going to have to be very intentional in this, but you're going to see tax cuts coming in both of these places. Now, where are we going to see other changes? Where are they going to try to offset? Because if they can't offset with spending, then they can only do this for a temporary period, just like they did in 2017. There was a sunset time period on these tax cuts. If you can fully offset this with spending cuts, you can make this permanent. And they're going to look to try to do that. The two areas where we expect to see them make cuts on this in order to make this permanent is one, green energy subsidies. This was something that was heavily invested in under the Biden-Harris administration. You're going to see more emphasis, I believe, over the next 2-4 years. There's going to be a massive emphasis on energy. Massive emphasis on energy. The biggest fight taking place in the US today is the fight between the US and China for the AI technology leadership. We are looking to bring chips production here, bring manufacturing here, and the data center usage alone, data center demand for energy over the next 2 years, the increase in demand here in the United States is expected to exceed the annual energy consumption of the country of Japan. This is massive. We need an all-out energy program. And so I think what you're going to see under the Trump administration is say, look, we're not going to do as much subsidization on the green side, but I will say this, we're seeing a lot of focus right now on nuclear. Did you see they're opening 3 Mile Island? How wild is that? They're reopening part of 3 Mile Island, and who has all the rights to that energy? Microsoft. Now, I've heard rumor, I haven't heard it confirmed, they use their AI bot in order to fill out the 2 million pages of regulatory filings. I'm not positive that's true, but you've also got Alphabet, Google, you've got Amazon saying we need to do this too. The demand for energy is so high because we sit here at, quite honestly, a pivotal point in technology shifts, and we are the leaders. Let's maintain that lead. I do think you will see continued investment in green energy, but I think you're going to see a deregulation, a freeing up, saying we need what we can produce. And at the same time, this has geopolitical implications. This is one of the biggest shifts we've noticed here on the global economic scale over the last 10 to 20 years, this shift towards the US going from the peak oil time period to an abundant energy net exporter has changed dynamics in the Middle East. It's changed dynamics for countries like South Korea, for Japan. Depending on where they can get their energy from, they're influenced by the countries that provide it. And by the US producing, it's moved power away from Russia, it's moved power away from China, it's moved power away from Saudi Arabia, Iraq, and Iran. Now, in addition to some of these movements, the cuts that they're doing on the green energy side, one other area I think you're going to probably hear about is they're going to try to work on some regulation related to the Affordable Cares Act and Medicaid. And the idea here is, as they've done studies, bipartisan studies, the efficiency of these programs has been brought into question. For the amount of money we spend and the health outcomes that we get, is there a better way to do this? And I think what you're probably going to see is a discussion about, can we block grant this and give it to the states? Let the states figure out how to implement that. Let them come up with they find to be the best ideas. They're going to be a bit more on the hook for the cost side if they don't control it. But let's get some competition in here to see who can design the best program. Let's try to make this as efficient as possible. Now, the two areas that I've heard the most question marks on that have got people nervous about a Trump administration is, first off, tariff increases. And I will say you're going to see tariff increases on China. That was going to happen regardless of who won the election. The issue in China is multifaceted. On one side, it has to do with economic competition, right? China has had a misunderstanding of copyright. They thought it meant the right to copy. And you've seen tremendous development in places like China over the last 20, 30, 40 years as the US or other countries developed the cell phone. And instead of going through the development process, China said, okay, we'll bring that in. They went from, horse and plow to having high-tech equipment. They skipped generations in technological advancement by bringing in technology from abroad. As they became the world's second largest economy, the rest of the world said, China, you have to play by the rules. You have to uphold these. This is the way that we work. if you want to get the products that we're developing, if you want access to US technology and you want us to invest in manufacturing and producing where you are, we need you to follow the same rules that everyone else follows. And China said, no, we're not a developed market. We're still emerging. We can still subsidize. We can still pay to let our countries produce at cheaper rates than anybody else. And the rest of the world has said, this is kind of reaching a tipping point. But more importantly, of late, there's become a geopolitical concern, right? China is now seeing a declining population. For the last 2 years, this is what happens when you have a one-child policy. Your population is declining. The aging of the Chinese demographic is putting more and more pressure on the younger demographic. And they realize that they're standing on the global scale. Their annual growth rates are moderating. They're starting to see more trouble. And they believe that Taiwan is Chinese property. And they're looking at this and saying, the longer we wait, the harder this gets. Should we try to act and show our dominance in Taiwan? Well, the sticking point in Taiwan is it's where about 80% of the highest end chips are produced in the world. We are dependent on Taiwan. Europe is dependent on Taiwan. India is dependent on Taiwan. If China were to invade Taiwan, they would see sanctions, just like Russia saw, but elevated. And China is making this decision. The US has said, look, as China's doing this, we need to make our own decisions. We're putting tariffs to try to block their subsidies because they aren't playing by the rules. We're starting to restrict some of the technology sent there because every time we send something there, they take it, they copy it, and they put a different name on it and say, no, this was ours. But they're also looking and saying, we need more US production on things like semiconductors, things like chips. We need these relationships for the sustainability to make sure we don't have this vulnerability in our pipeline. Now, the question of, are we going to see tariffs on other countries? Trump has said 10% tariffs across the board. Do I think that we're going to see those? I think the answer is no. Here is something I've heard said, and I think this is very true. Take Trump seriously, don't take him literally. When he says 10% tariffs across the board, I don't hear we're actually getting 10% tariffs across the board. When he says 10% tariffs across the board, here's what I anticipate to happen. He's going to go to other countries. He's going to go, for example, to Mexico. This conversation has already started. He went to Mexico and said, look, we are wanting to do work on the border. We want greater protection on the border. We want you, Mexico, to put more resources for security at the border. Now, if you do that, great. If you do that, then we're not going to put the tariffs in place. If you do that, then we've got our protections. This is what we really need. But if you don't do that, yes, we'll put in tariffs, and that's how we're going to pay for it. They're going to other places, right? They're going to other countries like Germany and saying, Germany, the Russia-Ukraine war, you committed to providing greater resources. The US by far has provided military resources, aid, and support to Ukraine, far more than any European country. And the administrations have asked many times, European Union, we want you to be more involved. You made commitments, 3% of GDP, but you haven't been living up to it. So now they come in and say, hey, we want you to live up to your commitments. If you do so, we're not going to do the tariffs. But if you won't live up to the commitments that you made, if we're footing the bill for it, then yes, we're going to put tariffs in place, and this is how we're going to pay for it. Now, tariffs are inflationary. All else equal, I do not like tariffs. I don't want to see a 10% tariff across the board. I don't think we'll see it. I don't want to see it, but this is going to be used as a bargaining chip. I think we'll see far less. I think what you're going to see is two things. One, okay, some countries, some companies are going to look and say, if I'm based in Germany, if I'm based in China, if I'm based in Mexico, and I do a lot of business in the United States, you know how I avoid a tariff? I put my plant in the United States. And we've already started to see this shift taking place even before the tariffs go in. I think that's one of the things that you're going to see. But I think the other thing you're going to see is a lot of these countries say, look, we want to have a good relationship with you. We want to have the capacity to access your market. We are the fortunate few. We are the 4% of the world's population that produces 25% of the world's output, which is truly remarkable when you stop and think about it. The rest of the world wants access. Now, the rest of the world is also shifting away from China. If you go back 5 years ago, China was the biggest importer. The US imported the most from China. Now they're number 3. Now they've fallen down. Canada and Mexico have passed them. If you remember back in 2018, Trump got new trade deals with those two countries and Japan. I think you will continue to see movement, but don't expect to see the magnitude that he promised in his campaign. Now, the last thing that I want to talk about here is a focus on immigration. This has been a piece that Trump has talked about. He says, look, we've seen a lot of immigration. This has put pressure on things like housing. The housing stock here has seen, particularly in the South, they've seen pressure on housing. They voted very heavily on this topic. Now, this is a tricky one because if you look at immigration and you look at U.S. employment growth over the last 4 years since COVID, we are up 8 to 9 million workers here in the United States. About 60% of that is immigration. When people come in and they work, we can produce more than we could before they were here. And so this is a tricky topic. You do broad enforcement on immigration, and the risk you run is a shortage of labor, maybe an easing on some of the housing in some areas, but economic growth would be impacted in the short to intermediate term. I would love to see immigration reform. This is going to be a tricky topic. But these last two pieces, the tariffs and the immigration, if you move on those aggressively, inflation is coming. The estimates is 1.5%, 2% inflation over the next year, which is going to put pressure on the Fed. Now, let's say that the Democrats hold the House. It's a similar picture, but there's some slight changes. I do still think you see most of the changes that are happening, most of the extension on the tax cuts. You would not see the you wouldn't see the corporate tax rate brought lower. It would stay at 21. You'd see the top marginal tax rate moved up. And in exchange for getting the Democrats to agree to most of the other extensions, you'd see an extension on the SALT tax, okay? State and local tax deductions. This is big in a lot of the Democratic states. Very last thing here is you're still going to see tariffs. This is happening no matter what. Tariffs were going to happen under Harris. Tariffs were going to happen under Trump. This is kind of where we are, particularly with China. It's just that stage that we're in development. Now, here's the thing. We've spent a lot of time talking about politics over the last few weeks. We've spent a lot of mental energy thinking about politics. And people have been, I've heard so many people already. Okay. Oh my gosh, I can't believe Trump won. I'm moving to Canada. Okay. And there was people that were like, oh my gosh, if Harris had won, I was going to move to Canada. Have you visited Canada recently? I was there in Toronto. There's not that many Americans. Yeah. And so we know that a lot of emotion's going to run up. But here's the thing. At the end of the day, right? This is one of my favorite charts. This is one of my favorite charts. If you let politics do the investment talking, you've massively underperformed, right? If you said, I'm only investing when the Democrats are in charge, I'm only investing when the Republicans are in charge, you've massively underperformed. What you've seen historically over time is that the top performance, and I apologize, I know some of these slides don't match up with what's in the book. We'll get the copies of the latest. When the election results came in, I'm like, I can talk about it now. But if you look at this chart, notice that if you had invested $10,000 back there in 1949, the performance of staying invested through Democrats, through Republicans, regardless of who was in Washington, you massively outperformed by staying invested through both. And this makes so much sense. It makes so much sense. When we stop and think about it, how many apps were developed by senators? Right? At the end of the day, what drives the markets? It's the innovation, it's the entrepreneurship, it's what we do, what the workers do, not what comes out of Washington. They are a piece of the puzzle, but they've never stopped growth, and they're not going to do it now. So when we sit there on the political front, we look at it, we pay attention, we look at where there's potential tax changes, we think about where industries may be supported or see some headwinds, but broadly speaking, we've said you need to stay invested through this. Time has been your greatest ally. Now, the Fed's job has gotten tougher, right? The Federal Reserve has two key tasks. They are told, we want you to focus on one, maximum employment. We want you to keep job losses low. And two, we want you to control inflation. They've had a tough time with this side over the last 4 years, right? The Fed's path with inflation is a bit suspect. You remember back in March, you remember March and April of 2020? Yes, you remember March and April of 2020 when we weren't sure if we were allowed to go to the grocery store, if we weren't sure if the coffee shops were going to be open, and we are all survivors of the great toilet paper run of 2020. You remember that? Why did we think we were going to run out of toilet paper? Right, but we went through that 2-month time period. We had this massive impact on employment. The Fed said, don't worry. If inflation's not going to come, but if it does come, it's going to be, you remember what their favorite word was for 2 years? Transitory. It's going to be temp. In fact, they were so confident that at the beginning of 2021, they said, don't worry, by the end of this year, inflation's going to be down to 1.7%. They had it down to 0.1%. Did we get to 1.7% at the end of that year? No, we were at 7.0%. So to their credit, they got one of the numbers right. They had the 7 in the wrong spot, but 2022 comes around. They said, we're going to have to lift interest rates. They said, we're going to do it 3 times. If we lift interest rates 3 times, inflation's going to end the year below 2%. They did 17 rate hikes. They only missed that forecast by 14 rate hikes, and we still didn't get down. We're still not down at 2%. We're still close to 3% when you take out the food and energy, which has been super volatile. And so the Fed is sitting here today saying, look, we think we know where we're going from here. Powell was out yesterday and said, I think we know where we're going over the next 6, 12, 18 months. But there's a lot of things that they don't know because we don't know them yet. What has them moving? If there's the risk of tariffs, if there's the risk of the tax cuts, if there's the risk of deregulation, which all say you should see a pickup in economic activity, you should see a pickup in market activity, but you should see a pickup in demand, a pickup in inflation. Why is the Fed so intent right now on continuing the rate cuts? They pointed to the jobs. They said the jobs is where we need to act. Okay, and if we can throw the slide up again real quick, if you look at this chart, it probably doesn't look too concerning. If you look at where the job gains are, the pace of job gains that we're seeing here over the last 12 to 18 months, it looks relatively similar to the pace of job gains that we had pre-COVID. But I will tell you, these 2 time periods are very different. And there's a couple ways you can see that. One, where are the jobs being created? What 2 sectors are dominating job gains here in the United States? 2 sectors have represented about 70% of job gains over the last 12 months. What are the 2 sectors? Government's number 1, healthcare is number 2, the largest government subsidized sector. Now, if you think about this, if the pace of job gains is running at about 160,000 as it was before COVID, and 70% is coming from those 2 sectors, it means only 30% is coming from everyone else. Small, mid-sized businesses, telecommunications companies, energy companies, information technology companies. Now, when we had that similar pace of growth pre-COVID, government and healthcare was about 12%. When government is the leading driver of employment gains, that's a bit concerning. I was recently in New York and I was talking with their school boards, and the school boards were saying, yeah, we've had a lot of revenue come in, so we did a lot of hiring. And now our tax revenues have flattened out. In some areas, they're down. It turns out some of that was stimulus spending. Some of that was additional grants that were coming through during COVID. But now we have to make a decision. Are we going to let go of some of those people we just hired, or are we going to raise taxes? Which side do you think they're leaning towards? Raise taxes. And so I look at, from an economic growth perspective, the growth now versus the growth 5 years ago aren't equal. And the Fed has kind of acknowledged this as well. Now, some people say, hey, look, at least a job is a job, right? At least a job is a job. And people are working, they're raising money, they're able to spend in the US economy. And I agree to a degree. But then you look at another piece of information. How good are the jobs? In quote unquote normal times, let's go back to the 5 years before COVID, full-time jobs, which tend to be more career-oriented, they tend to be higher paying, they made up more than 100% of job gains. Now, how do they make up more than 100% of job gains? If we were adding 160,000 per month, we were seeing 170,000 in full-time jobs, and part-time jobs were declining because people were moving from part-time into full-time. Over the last 12 months, what percentage of job gains are full-time? It's actually a trick question because it's negative. We're down full-time jobs in the last year, which is a bit unusual. Has it happened before? The answer is yes, right? It has happened. If you look, you had it twice in the 70s, twice in the 80s, once in the 90s, twice in the 2000s, and again in 2020. But if you can see, it's a little hard. If you could see, there's these gray shaded lines every single time before this, over the last 60 years, every other time that full-time jobs has gone negative, it's been associated with a recession. Now, we are not in a recession today. We aren't. We just got GDP numbers and they were strong. We're seeing business investment numbers. They're strong. We're seeing consumption numbers. They're strong. This time is a bit different. We're seeing greater productivity gains than we've seen through past cycles. That $4 to $5 trillion that got put in the system during COVID, the economic morphine, has helped avoid some of the pain. But the Fed is looking at this and saying, all else equal, okay, we want to act on the employment side of our mandate. Inflation's been coming down. All else equal, we want to act. We want to bring rates lower, but here's the risk they have. When Powell was asked yesterday, Chairman Powell was asked, what does the election mean for you? Powell's response was nothing. It means no, in our outlook right now, we're not doing anything based on the election results. And as an economist, I sit there and think, if you're getting tax cuts, and if there's any of these tariffs, and you're cutting rates, there's going to be inflation pressure. How are you not considering it? He said, well, we'll have to see what they bring. We don't know what they're going to bring. And so this is kind of the MO of the Fed. They're going to act until they see the changes, but by the time they've seen the changes, typically they're a little slow to react. I think you are going to see some inflation pressures next year. How the Fed deals with them, the sooner they address it, the better. And I'm sure Dr. Ardeni will talk about this afternoon. That is one of the risks that's on the table from an inflation standpoint, is that the Fed could move too slow and we could see inflation move higher. Now, where are the inflation pressures coming from? In order to understand the inflation pressures, I want to point you back to, again, 2020. But let's move past March and April. Let's move past the shutdown months. Let's talk about the back half of that year. As we got into June, July, August, September, October, November. Do you remember in 2020, how many of you took a flight during the second half of that year? Few people, okay? If you took a flight during the second half of that year, it was awesome, right? You went to O'Hare and you parked anywhere you wanted. You walked straight through security. You got your own row on the plane. You went to the rental car center and they were like, it's a free upgrade. We got like 80 cars here. There's 3 of you. But if you remember this, right, if you look at the goods side of the economy versus the service side got decimated. We didn't have the live sports. The hotels were really struggling. The restaurants, when they couldn't do the in-person, the sporting events were heavily impacted. This was the time where we moved from the outside inside, the inside online. And this is as a reminder when we had where Peloton was the greatest company on earth for 2 weeks. You remember this? It made so much sense at the time. We're like, of course Peloton we can't go to the gym, so I'm going to buy I'm going to buy 2 Pelotons. And I'm going to put them in the basement, and me and my spouse are going to wake up every day. And we're going to cycle against all the neighbors, and when COVID's done, the US is going to be the healthiest country on earth. And it lasted for 2 weeks because that's like how long it takes you to realize you hate cycling, right? But during that time period, if you turned on the TV, you probably heard about the Port of Long Beach. The Port of Long Beach with its 111 ships waiting offshore. 11 days to dock and look. We started to have supply chain issues. And the Fed, in the early stages, said, well, if that's our issue, if the supply chains are our issue, let's put the resources there. Let's incentivize businesses to hire. Let's move the workers from the service side where they can't be to the goods side where we need them. And we moved workers, we moved resources, and we did it just in time for everybody to want to get back outside. Now, here's where things get really strange from an economic standpoint, because I did my first 2 years of school at North Central. When my dad was there, I followed a girl to another school. We're married now with 2 kids. It was a great idea, okay? But when I was in my economics classes, if somebody had told me, here's the environment you're going to find yourself in, the good side of the economy has now been essentially flat for 3 years. And over the last 2 years, they get surveyed every single month. They get asked, how are your orders? How's your production? Are you hiring? Do you have order backlogs you're still working through? Can you get things in and out? Well, for 23 of the last 25 months, they've said our orders are down, our production is down. They said, we're in a recession. The demand for our goods, our services, surged during COVID, and now they've slowed. People are back outside, back on the trips. They're doing revenge vacations. Now, put yourselves in the shoes of one of those business owners. If you've had orders down, production down, and you've worked through your order backlogs, if you haven't seen order gains in 2 years, do you think you are A, saying this seems like a great time to build a factory, do some new tooling, bring out a new product line, or B, you're saying, I think I'm going to hold off right now. Let's see when things turn around, when activity picks up, and then I'm going to act. Which side would you be on? Your CFO is going to tell you, I want you on B. Okay, if we haven't had orders in 2 years, If we haven't seen growth, let's hold steady until things turn. Now, let me remind you that over this same time period, exact same time period, you have seen interest rates, the cost of borrowing to make these investments, rise substantially. You went from 0 to 5.5% on the Fed funds rate. You saw small business loans go from 4.3 to 9.3. When it's more expensive to borrow and buy a house, do people buy more homes or less? Less. When it's more expensive to borrow and buy a car, do people buy more cars or less? Less. When it's more expensive to borrow and invest in your business, all else equal, do people do more investment or less? Well, historically they do less, but this time we got this. How do you explain this? When you don't have orders, you don't have production, it's become more expensive. You said, let's triple spend. It makes no economic sense until you realize the Fed wasn't operating in a vacuum. And at the same time that the Fed was cutting rates in order to try to moderate, or raising rates in order to moderate inflation, Congress came out and said, that's great. We want to see inflation come down too. But we got that election coming up, and we like getting reelected. And we tend to get reelected when the economy is growing, when people aren't losing jobs, when there's spending taking place. So we're going to do the CHIPS Act. We're going to do the Inflation Reduction Act. We're going to subsidize activities in the areas where they don't currently have business. We're going to promote them to growth because we think we're going to need them longer term. But it created a dislocation in the economic system. Now, here's the thing. I agree we need chips. And the TSMC plant, Taiwan Semiconductor Manufacturing Company, that plant that's down there in Arizona is incredible. It's yielding now at similar levels to what we have in Taiwan. Now, some of the other chips are having a harder time. The Intel plant that's going in New Albany, Ohio. Has anybody here been to New Albany, Ohio? Yeah. Did you see the plant? Oh, okay. I'm not telling you to go vacation in Columbus. But if you find yourself there, especially if you end up in New Albany, go see this new site. It is incredible. It truly is. It looks like a miracle of modern engineering. The scale of it, it's bigger than downtown Naperville. This plant is enormous in its scale. And as you roll into town, the first thing you're going to notice is all the roads are brand new because they needed new energy infrastructure. All the sides of the roads have been ripped up because they need new water infrastructure. It's causing massive, massive investment in this area. It's $22 billion, $9 billion in grants, $11 billion in subsidized loans, 25 years they don't have to pay state level income tax, 25% on their federal tax reductions for any R&D spending they do. There's a lot going into this plan. Now, how has Intel been doing this year? Their stock's down about 55%, and they recently announced they're letting go of 10 to 15,000 employees. There are pieces of this where we've invested heavily. It does promote growth. There's pieces of this that are going to succeed. There's pieces of this that are going to have a little bit more trouble. But here's the problem it created for the Fed. As we invest in the AI and the infrastructure before we've seen the production from it, these companies have said, well, even if we don't have the orders right now, if we've got a plant coming online in 6 months, 12 months, we're not going to let employees go right now. Qualified workers are still hard to find. We're going to hold on to them. So here's the problem that it's created. Okay, here's inflation. Inflation's trending lower. Not moving as fast as it was before. It's starting to level itself out. We've got the goods inflation, which was the supply chain issue, rose up and fell. But when we move the workers from the service side, move the resources from the service side, we move the problem to the service side. And this has been slower. Now, as small and mid-sized businesses pull back, right, we're seeing some easing on the inflation front. As the Fed cuts, there's a risk that this is going to accelerate. But I did my grad school up in Northwestern, right up in Evanston. One of the benefits that we had at Northwestern is that we had a campus in Evanston and a campus in downtown Chicago, right off of Superior. And what we would do is they said, if you want to take classes up in Evanston, you can take the classes here. If you want to take classes for people in the industry, you can go down and they'll do night classes at the downtown campus. So if you want to take a marketing class from one of the people that runs a marketing firm, they do that as their 9 to 5. They'll come teach 6 to 9. You want to go take an accounting class. We'll bring in people that are running accounting businesses. They do that 9 to 5. They come in 6 to 9. We had the head of research for the Chicago Fed. So we had this relationship with the Chicago Fed. So my friends went over and worked for the Chicago Federal Reserve. And when I asked them, what in this picture has you nervous about getting inflation down to 2%? They surprised me. They said, it's that orange line. It's the goods. We have some concerns over the goods side because one of the issues that we've been seeing that, quite frankly, we have no control over is the geopolitical conflict. And the rise we've seen, particularly in the Middle East with Israel and Gaza. They said Hamas has been firing on ships in the Red Sea. The Red Sea is the entry point to the Suez Canal. Suez Canal is the most important trade route into Europe. And they said, look at what's been happening with global freight rates. They escalate, they moderate, they escalate. You can see it's been turning here of late. Now, if tariffs are coming in, expect more pressure on this before the end of the year. If countries think that the tariffs are going to hit them, companies are going to try to do massive imports before January 20th. In order to try to avoid it, we're going to continue to see pressure on freight rates. Now, freight rates, does Google, does Amazon, does Apple, do they import their products and set their freight rates a week from now? Say, hey, I'm doing this massive shipment in a week. Let's set prices today. No, they've done this 6, 12, 18 months in advance. As this rolls over for these organizations, they're expecting some of these pressures to rise. And so the Fed said, look, we still have inflation concerns. We want to cut because we want to ease on the jobs front. We want to make sure we don't see that dreaded R word. We want to help ease the pressure on some of the groups that are having difficulty, but we still have to deal with inflation, and those inflation pressures may be a concern for next year. Now, the markets are still going to focus on interest rates and earnings. This chart, by the way, this earnings chart is more miraculous than you think. If we were to show, and I wish I had put it in here, the chart of the world US, how is everyone else's earnings outside of the US? Theirs have been relatively flat. This is over the last 12, 13, 14, 15 years. The US goes bottom left to upper right from $40 to a six-fold increase. The rest of the world is roughly doubled. Why? Because we are the leaders in technology. We sit in a world today where the US innovates, China replicates, and Europe regulates. And it's hard to understand just how incredible our dynamic is right now. That as we sit here, and I'll be honest, I don't know exactly what the AI play out is going to look like, just like we didn't know the internet. Do you remember, how many of you were here in downtown Naperville for Y2K? Do you remember our ball drop? We had the ball drop over by the Carolina, and the ball is dropping, and people are like, oh my gosh, what's going to happen at midnight? 5, 4, the light's going to go out? Is my tape I picked up from Blockbuster still going to work? And 3, 2, 1, nothing. Nothing. And we're sitting there in downtown Naperville. We're like, oh my gosh, all that lead up to nothing. At the time, we weren't sure what the internet was going to bring. Now, what we knew, we were excited about the internet, and the internet has been the most transformational technological achievement over the last 30, 40 years. I think AI will do that, but just like we have anxiety, where we have angst, and we have a lot of expectations on AI, we need to be patient. We are the drivers. We are the leaders. I think this is going to be critical, this earnings growth. Okay, but here's what, if we stopped in 5 years, if we were in this room in 5 years, if we were in this room in 10 years, and we look back and say, where did the growth come from? What drove the markets over the last 5, 10 years? What were the most influential factors? I don't think it's going to be how much did the Fed move rates in December. Quite honestly, I don't think it's going to be the tariffs that come through. I think we're going to be looking back at what's happened from things like this. Okay, my last few charts here in the last few minutes, I want to leave here with, I want you to understand what's happening in the world around us, because it is magnificent. This is the percentage of the global adult population that is literate, that can read. Now, this surpassed 50% for the first time ever in 1963. For a lot, that's their lifetime. Like in their lifetime, we went from just passing half the world's adult population being literate to that number closing in on 90%. And what has this done? As we, back then in 63, had 6 billion people on this earth, and we now have 9.3 who are better fed, better educated, better nourished, with better health care. Child mortality rates have never been lower. Violent crimes have never been lower. Right? These rates are declining relative to the populations. As this has taken place and we've been unlocking human potential, is it a surprise that we're seeing this? The share of world population living in poverty. Now, this chart is hard to understand. Sometimes in economics, there's numbers where I'm like, I don't think people really get it. When we run a $1.8 trillion deficit, it's hard to understand what $1.8 trillion is. That's such a large number. By the way, I asked the government if I could borrow $1.8 trillion. They said no. And I said, look, you let me borrow $1.8 trillion. Here's what I'll do. I will pay you back $100 per second. $100. $100, $100, $100. I will pay you back $100 per second until it is fully paid back. Now, assuming I've got no interest, it would only take me about 64,000 years to pay it back. I want you to do the math with me on what this is doing, okay? Because we are in a global environment. When we US-based companies are selling, 45% of our sales are around the world. As companies are building and they want to do it here, they want their research here, they want their resources here, they want their development here. Here's what we've been unlocking. Let's take a look at the last 20 years and understand what's been happening here with extreme poverty, the percent of the world's population that's living on $1.90 per day or less. Okay, in 2003, 21 years ago, we had 1.6 billion people in extreme poverty. Last year, latest data we have, it was 713 million. Now that's 713 million too many, but that means that over the last 20 years, we've seen 906 million people move out of extreme poverty. To see them improve their life, have greater resources, greater capacity, not just for themselves, but for their families. Now here's where it really gets crazy. Okay, there's 7,305 days over that time period. That means that we've averaged over the last 20 years, 124,000 people per day moving out of extreme poverty. 124,000 people per day. When I was born here in Naperville 40-ish years ago, our population was 75,000. The Naperville population has doubled since then. We have 150,000 people, which means that every day and a quarter, the population size of Naperville is moving out of extreme poverty. And as they're doing so, they're looking to come here to build businesses. They're buying the products that we are developing, that we've got the leadership stake in. As we look out here into 2025, there's going to be some inflation pressures. The Fed has some work to do, but we are in the process of seeing what this unleashing of human potential is doing in the development of technologies, and it's moving at a pace that we have never seen before. Productivity is accelerating. Output is accelerating. Doesn't mean that it'll be completely smooth sailing, but I think, we've got a lot to be thankful for as we come up to Thanksgiving here this month. I think 2025 has the potential to see some significant moves. Now, I talked for longer than I was supposed to. I am over by 1 minute and 53 seconds. But I thank you for taking some time out of your day today. I thank you to the whole team. Thank you for giving me the opportunity to be here. If you've got questions afterwards, I know we got to keep things moving. If you've got questions, reach out to anybody on the team. If you've got friends, neighbors who have questions, have them reach out to the team. We are one of many resources they have available to them to dive into the data, to look at what's going on. And if we can be a resource to you, please don't hesitate to let us know. Thank you. Enjoy the rest of the day.